Welcome to the FEDLIFE Podcast with Dan Sipe from Serving Those Who Serve. In this podcast, Dan draws from years of financial experience to help federal employees overcome challenges that every Fed can relate to. Join us for this journey as we reach, teach, and serve to help you make the right financial decisions. Now, on to the show.
Hello and welcome to this episode of the FEDLIFE Podcast. I'm your host, Dan Sipe. Additionally, I'm branch manager here at Serving Those Who Serve and Sipe and Associates, and I will begin as I always do by saying thank you. Thank you for taking the time to listen, but above all, thank you for your service to the government, to the country, to me, to everybody. You don't hear that enough. You'll always hear it here. The other thing that you will always hear here is the guru, Ed Zurndorfer. He is back with us once again as part of our ongoing mission to reach, teach, and serve you, the career civilian Fed. Now, at the outset, I need to say that the opinions of our guest, Ed Zurndorfer, although we think they are awesome, are not the opinions of Raymond James or Serving Those Who Serve. This podcast is presented for information only and is not meant to be taken as advice. All listeners should consult their personal advisors before taking any action. And if you don't have a personal advisor, hit us up at stwserve.com. We will help you any way we can. So if you're a regular listener, you know, one of the things we try and do is follow Ed's Fed Zone articles because he writes every week for us. That's fed-zone.com. And these are ones that you are definitely going to want to head over to the Fed Zone to read on the screen, print out, whatever, because there's tons of tables, tons of examples to go along with this. We're gonna talk through it, but you will want to have those examples. And so today we're digging into a topic that most Feds probably spend zero time thinking about, and that is inheriting an IRA from someone other than your spouse. So a parent, for example. Now, Ed, back in the day, if you inherited an IRA like this, you pretty much had your whole life to take the withdrawals out. So tell us what changed and why.
Well, Dan, Secure Act 1.0, which was passed in December 2019, took effect January 1st, 2020, changed the rules regarding when an individual inherits an IRA. Now, when I say an IRA, I'm including both the traditional IRA and the Roth IRA, both. And what changed was the fact that before January 1st, 2020, when an individual, it could be a child, could be a grandchild, could be a niece, nephew, a friend, anybody who inherited an IRA from someone else, they had the option. They had to take the money out of the IRA. They could not leave it in there indefinitely. They had to take money out of there. But one of the options was to take the money out over what's called their life expectancy. So, for example, here, mom dies at the age of 85. Okay, and mom had a huge IRA worth $500,000 at the time of her death, and mom had named as beneficiary her son, who is 55 years old, the only beneficiary. Mm-hmm. Well, her son, who's 55 years old, has a 30-year life expectancy, say, till age 85. He had the option of taking out a minimum each year. That's what we call a required minimum distribution based on his life expectancy.
Right.
And that would be like 1/30th of the balance in the IRA, thereby spreading out the distribution of the IRA. Now, keep in mind, Dan, that mom's son has to pay tax on that traditional IRA. The tax has to be paid on the traditional IRA withdrawals. And taking the whole thing out, we're talking about in this case here, mom, the account balance at the time of mom's death is $500,000. I don't think it's a good idea to take out all $500,000 in 1 year. Think about the tax implications about that, both federal and state.
You're giving me heart palpitations just even suggesting that.
So her son tells the IRA custodian that, yeah, you can put the IRA in my name now. It's called a death IRA or inherited IRA, also known as a death IRA. And I want you to each year send me the minimum amount. That's the required minimum distribution based on my life expectancy. And now her son would have a lifetime income from that. So in that sense, it was a very good law. At least they had the option. Well,
Sure.
With the passage of Secure Act 1.0, things changed. And what Secure Act 1.0 said is that if someone dies after December 31st, 2019, and they are the beneficiary of a traditional IRA or Roth IRA, they're not going to have this option of taking out the money of their life expectancy if they are not what's called an eligible designated beneficiary. What is an eligible designated beneficiary? A spouse, a relative who is no more than 10 years younger than the IRA owner.
Mm-hmm.
That could be like a brother or a sister. It could be a friend. Anybody can be named as beneficiary of one's IRA, as long as that friend is not younger more than 10 years than the IRA owner. Then that designated beneficiary, the friend, can have the option of taking the money out over their life expectancy. But everybody else, a so-called non-eligible designated beneficiary, cannot do that. They have to take the money out, and they have to withdraw all the money within 10 years of the IRA owner's death, within 10 years, Dan. So that's a big change.
That is a huge change. So the deal is now it's got to come out in 10 years. And within your article, the first item you bring up, and it's great that you go into this kind of detail, is something called the year of death distribution. So this would be for somebody who is with their own IRA, they're at required minimum distribution age, and they die in the year before they do it, correct?
In other words, they died during the year in which they were the IRA owner had to take out a RMD because they had reached what's called, Dan, the required beginning date. Now, I'd like to spend just a few moments about what is the required beginning date.
Sure.
Before the passage of Secure Act 1.0, again in December 2019, took effect January 1st, 2020, the required beginning date was as follows. When an individual, this is the IRA owner, reaches age 70 and a half, they are required to take out an RMD, and their first RMD is due no later than April the 1st following the year that they turn 70 and a half.
Gotcha.
This is before the passage of Secure Act 1.0. When Secure Act 1.0 was passed, the required beginning date was changed to as follows. If anybody was born after June the 30th, 1949, like myself, your required beginning date is April 1st following the year that you turn 72. April the 1st following the year you turn 72.
Gotcha.
Then, with the passage of Secure Act 2.0, which was passed this past December 2022, the required beginning date was changed again. Anybody born between January 1st, 1951 and December 31st, 1959, like myself, okay, your required beginning date is April the 1st following the year that you turn 73. And finally, anybody born after December 31st, 1959, your required beginning date is April 1st following the year that you turn 75. All right. So what does this mean? What does this mean now in terms of required minimum distributions? Let's say an individual has met his or her is old enough, they're past their required beginning date, and they have to take out RMDs. And let's take, for example, someone who turned 75 years old this year, because they are past their required beginning date, and they own an IRA, and they passed away sometime this year. Let's say they passed away in April of 2023.
Yep.
And they named the beneficiary. Well, even in the year that one dies, the individual still must have taken his or her RMD. You don't get a freebie here.
Okay. And
whose responsibility is it to take out that RMD of the deceased, the beneficiaries, the beneficiary? Okay. I've seen this too often, Dan, because in my accounting and tax practice, where I get a child whose parent passed away, and that parent had passed their required beginning date, and they said, "Oh, by the way, my father, my mother, whoever's that we're talking about here, died last year and did not take his or her RMD." Now, this is in the spring after the year the person died. And the person said, "Should I have taken out the RMD?" I said, "Yes, you should have taken out the RMD." "Well, can I take it out now and include it on the estate income tax return?" I said, "No, no. It's going to be included in your deceased parent's income tax return for the year that he or she died." So this is very important. And as a tax advisor, what I advise my clients who are subject to RMD is, it's a good idea to take out that RMD as early in the year as possible.
Sure.
Why? I want the money to keep growing tax free. Why do it's bad enough I got to take the money out, they say to me. I realize that. But by taking it out early in the year, God forbid you pass away, the responsibility of your, when your relative, your children or someone are taking care of your tax stuff, they might forget they have to take out the RMD on your behalf. They might forget to do that.
Sure.
And if one does not take out one's RMD, IRS has a penalty. It used to be, until the passage of Secure Act 2.0, that there was a 50% penalty.
Ouch.
For not taking out one's RMD in a given year. Now, 50% of what? If a person, let's say, had an RMD, let's use the number, Dan, $10,000. And they didn't take out the $10,000, none of it, or maybe part of it. They didn't take all out of it. The 50% penalty is 50% of what they should have taken out, but they didn't.
Gotcha.
So the person didn't take out $10,000, IRS is waiting for a $5,000 payment. And the penalty accumulates over the years.
Oof.
For every year you don't take out your R&D, you're going to pay another 50% penalty every year.
Oh. Ouch.
Now, Secure Act 2.0 did something that is helpful for IRA owners. The 50% penalty has been reduced to 25%, plus the fact that if one corrects the fact they didn't take out the RMD and they make that RMD payment within 2 years of when they should have, there will be no penalty.
Gotcha.
Okay.
Well, that's better.
And so that's a better thing. But the point again, Dan, is the fact that when you reach that required beginning date, you own an IRA, traditional IRA. You have to keep that fact in mind, even a Roth IRA, because Roth IRAs are not subject to RMD, but when one inherits a Roth IRA, they have to take the Roth IRA out by a certain time as well. Roth IRAs are, in a sense, are subject to the RMD rules too, except you won't pay any tax. The beneficiary doesn't pay any tax, but they have to take the money out. They can't leave it in there indefinitely.
Yeah, that was one I was sad to see go.
Yeah.
So Ed, let me ask you this, because, a lot of times, especially if it's mom or dad passing away, they have more than one child. So there might be multiple beneficiaries. So if they didn't take their year of death distribution, there's multiple beneficiaries. What's happening there?
Well, IRS says only one has to take out the RMD, on behalf of their parent, or IRS now says, as a result of the passage of Secure Act 2.0, they can take it out of their inherited IRA on behalf of the parent, because after all, it's coming from the same source.
Gotcha.
Or if we have, let's say, 5 beneficiaries, 5 children, each is getting 20% of the inherited IRA, each could take out the portion, 20% of their inherited IRA portion as part of their to satisfy their parents' year of death RMD.
Gotcha. Now, I want to loop back to something here, Ed, because I think this one's important. You bring up that term, which is the eligible designated beneficiary, and you mentioned obviously a spouse is not covered under this, so this is non-spousal. But if someone is the EDB, then they're able to go out over a lifetime. And you mentioned, kind of the 2 types that go there. One thing I didn't hear you mention, and I just want to clarify it for our listeners. What about a disabled beneficiary receiving the IRA? Where do they fit in as far as eligible or not?
Yeah, disabled is considered to be an eligible designated beneficiary. Disabled. But I got to tell you, Dan, IRS has a very rigid definition of what disabled is.
Mm-hmm.
You got to be very careful about that.
Okay.
I mean, I liken it to what Social Security says. If somebody applies for Social Security disability, they really have to prove that they are truly disabled.
Gotcha.
And
obviously I'm thinking in terms, and why, of say a special needs recipient. Okay, so so someone who's developmentally delayed or something like that. Yeah. In most instances, we're seeing them qualify for the Social Security definition of disability.
Yes.
And so, that is, and I'm just confirming that as one place within the code where there's a little mercy on this thing, regardless of that person's age difference from the beneficiary, if they have that persistent lifelong condition, they would potentially be an eligible designated beneficiary, correct?
That is correct. That is correct. Absolutely.
Okay.
Absolutely.
And then they'd still be able to stretch over a lifetime.
Yeah, and they can stretch over a lifetime. I wanted to just say one thing about that, though, Dan, that just because you want to, someone that says, I like to stretch it over my lifetime, does not mean that they can decide, well, 1 year I'm going to need this money. They can cash out the whole thing.
Gotcha.
You're not tied into that. I mean, I always, talk about the fact, that let's say and this gets back to the spouse. Yes, the spouse is an eligible designated beneficiary, which means that the spouse, they can draw from, when they inherit their deceased spouse's IRA, they can take lifetime payments. By the way, the spouse also has the option of transferring the entire inherited IRA into their own IRA.
Sure.
And that'll give them more options. But if they decide not to do that, spouse says, I'd rather just get lifetime income from my deceased spouse's IRA. And let's say the surviving spouse is, let's say, 72 years old. So I think over the next 15 years or so, that's my life expectancy. I like to get, a payment each year. But
Gotcha.
then 6 years later, Dan, the surviving spouse has to go into a nursing home and needs a lot of cash. Or maybe they need home health care. They need a lot of cash. Where's the money going to come from? Let's cash out this IRA. So that gives them that option in which they could decide, no, I'm going to stop the payments. Let's just pay out the balance in one lump sum. I'll pay the taxes, especially if the one's going to incur, they're going to incur a lot of medical expenses. They're going to say they go to a nursing home. They're going to need home health care on a full-time basis. They're going to have enough medical deductions to offset the income coming from cashing out that IRA.
Sure.
So again, the point is you're not tied into the lifetime payments.
Gotcha. And, so that's the eligible designated beneficiaries. Now, when we get to everybody else, they've got 10 years, but it's not take it out any way you like, correct? So they've got to take a certain amount out.
Yeah. We're getting into the weeds here, Dan.
I tell you, confusion around this.
I'm the first to tell you, this is not easy stuff. And it took a while for me to digest the information I received. When I got the information, it took me a couple of days to sit down to understand it, and that's when I wrote it up for the Fed zone. And I think it's worth, when we talk about this, to go through the examples I put up there. In the Fed zone, and all the columns appeared in the during May at in May, and one column was in early June at www.fed-zone.com, www.fed-zone.com. Just key in the word inherited IRAs, Secure Act 1.0, 2.0, it'll pop up.
Gotcha. So, but to clarify, we've taken care of whether we had a year of death distribution. Now we're out into our 10 years, and they've got to take something every year. They can't just wait until year 10 and take it all, correct?
It depends. Okay, so let's just review the rules here in terms of the beneficiaries who do not qualify as eligible designated beneficiaries. I call them EDBs. We have non-eligible designated beneficiaries. They are NEDBs. Okay. And they are not permitted to take lifetime distributions. Instead, they have to adhere to what's called an expedited 10-year payout schedule.
Okay.
Now, we are talking about both about traditional IRAs and Roth IRAs Okay. Mm-hmm. Now, how they take it out during the 10-year period will depend on when the original, in the case of the traditional IRA owner, traditional IRA owner, this is the original owner, when he or she died, okay? When he or she died. Because if the original traditional IRA owner died before his or her required beginning date,
mm-hmm.
which we went over a few moments ago, then they have a 10-year period to take out the entire balance of the inherited IRA. But they're not required to do anything with, until the 10th year. They can just leave it alone for 10 years. There's no RMDs in this case here. No RMDs in this case here. If the inherited IRA owner died after reaching his or her required beginning date, then not only do they have to take it out within the first 10 years in the case, and again, this is the traditional IRA, each year they are subject to an RMD. Gotcha. This is the person, the NEDB, who is inheriting the IRA, they're subject to RMD during years 1 through 9.
Gotcha.
And by the end of the 10th year, it has to be all withdrawn, entire. Let's do an example here.
Sure.
Okay. Let's do a couple examples here. It'll make it easier for our listeners to understand what's going on here. So here's the first example. We have Elizabeth. She's age 65. She died on July 15th, 2022.
Mm-hmm.
She named as her beneficiary her son, William. Okay. Now, Elizabeth, because when she died at age 65, she died before her required beginning date. William, as a non-eligible designated beneficiary, because obviously William is more than 10 years younger than Elizabeth.
Sure.
William decides he's subject to the 10-year rule. Okay. And he decides he's going to take out each year 1/10 of the account balance. 1/10. Elizabeth died on July 15, 2022. When does William have to take out his first payment? No later than December 31st, 2023. That's
okay,
the
so
year,
the next year.
Then December 31st of the year following when Elizabeth died.
Okay.
His last withdrawal has to be made no later than December 31st, 2031. That's his last. That's the deadline for him taking out his inherited IRA.
Okay.
Okay. And he's doing it very easily. What he does is, William, he takes the inherited in his first. Let's take the first year. Okay. This is this year, December 31st, 2023. To calculate what he's going to take out this year, he takes whatever the inherited IRA balance was as of December 31st, 2022.
Gotcha.
You always go back to December 31st of the previous year, and he divides it by 10. He divides it by 10 because he's got 10 years to take it out. He's going to take out 1/10 each year. Okay.
Sure.
All right. That's for 2023. Come next year, December 2024, he's going to take out his next inherited IRA. This is the second inherited IRA withdrawal. How does he calculate that? He takes the account balance as of December 31st, 2023.
Gotcha.
And divides that balance by 10. Okay. And for his last inherited with IRA withdrawal, I got to correct something I said a few moments ago. He has to his first inherited IRA withdrawal is being done this year, 2023. His last withdrawal we made no later than December 31st, 2032. I said 31. I'm sorry, I meant 2032.
Gotcha.
So he has to have the entire thing cleaned out by December 31st, 2032. All right? All right.
Gotcha.
Now, a couple things here. I just want to mention about in the case of William. Like I said a few moments ago, yeah, he's taking out an equal amount each year. He does not have to do that. He's not subject to any minimum distribution during the year, during the years, let's say 1 through 9. He has to clean it out by the end of year 10. Because this is a traditional IRA, it's probably not a good idea to wait to 2032 to take a lump sum withdrawal.
Sure.
For the whole thing. Think about the tax consequences.
Oh yeah, he could get clobbered.
He could get clobbered. So it's probably in William's best interest. Number one, he should talk to his accountant. What would be the best way to take this money out? Should I do it evenly? Maybe in a given year, William may have some losses. Maybe he has some, he owns some property and took a big loss on the sale of a property. Has a huge capital loss. Okay. Maybe he should, in that case, he should take out more from the IRA, from the inherited IRA, because he can use the, you can use that loss to offset what's coming out of the IRA. Okay.
Gotcha.
So it's a recommendation that when you inherit an IRA like this, especially if you're talking a huge IRA, hundreds, a couple $100,000, $500,000, and some individuals out there have done so. They should talk to their tax advisors as to what is the best way, most tax efficient way to take this money out.
Sure. No, that makes all the sense in the world. And so that was if the beneficiary hadn't reached the required beginning date.
Yes.
So from what you explained earlier, if the beneficiary has already started taking RMDs, now there's sort of two layers of rules here. So the beneficiary has to take something out during the 10 years based on their life expectancy, but they still need to empty it in 10 years?
They still have to take it out. They have to take it out within the end of the 10th year. That's correct. That's correct.
So I guess it's possible, depending upon the age of the beneficiary, that, and we're getting really deep into the weeds here, folks. So this is why you really need to go to the Fed Zone to look at the examples. But the younger somebody is, the smaller bite it's going to be that would be their life expectancy amount. So somebody who doesn't have good guidance on this could be bouncing along for 9 years, taking little sips from this thing, and then suddenly be faced with taking a huge chunk out in the 10th year, correct?
That is correct. That is correct. So again, tax, talking to a tax advisor, is very important. They're doing this before when you inherit someone's IRA, you are the non-eligible designated beneficiary of an IRA, and the IRA owner was subject to the RMD rules himself or herself. So let's do an example here to illustrate. We have Christopher. He's age 82. He also died in 2022. Christopher named the beneficiary of his IRA, his son Daniel. Daniel is age 56.
Sure.
Daniel is a non-eligible designated beneficiary and must abide by the 10-year rule. Since Christopher died after his required beginning date, Daniel will have to take annual RMDs from the inherited IRA based on his own single life expectancy.
Sure.
For the years 2023 through 2031. That's years 1 through 9, following the year that Christopher died. By the end of 2032, the whole thing has to be distributed.
Gotcha.
Right. So how does Daniel compute his RMD? Now, Daniel is subject to RMDs during years 1 through 9 again. The RMD is calculated by taking the account balance in any given year, the account balance in the IRA as of December 31st of the previous year. And this is important, a life expectancy factor. Now, whose life expectancy factor?
I'm going to say it's Uncle Sam's. Uncle Sam decides.
The beneficiaries. So where do you fit that information? You go to IRS publication 590-B. It's entitled Individual Retirement Arrangements - Distributions. There's an IRS publication 590-A, which is Individual Retirement Arrangements Contributions. But this one, we're talking about distributions. We go to IRS publication 590-B, in which you see life expectancy tables. And there is 3 life expectancy tables. One is Table 1, which is entitled single life expectancy.
Gotcha.
We're talking about the lifespan of one person. And that's the one we're going to use now. When Daniel inherited his father's IRA, he was 56 years old.
Yep.
Okay. His first RMD, this is for the year 2023, he's going to be 57 years old. So you go to the table and you look up 57 years old, and the life expectancy factor for a 57-year-old is 29.8 years. So you take the account balance as of December 31st, 2022, divided by 29.8, and that'll be the year one RMD for Daniel. Okay. Then we go to the year 2024. So how is Daniel going to compute his RMD for year two? That's 2024.
I'm guessing he moves to the next line on the table.
No. Actually, we do, well, first of all, we start off, we got to get the account balance in the inherited IRA as of December 31st, 2023.
Gotcha.
And then we got to figure out what is our life expectancy factor. Very simple. We take the life expectancy factor we start off with for 2023. Remember 29.8, Dan?
Yep.
We subtract 1.
Okay.
Now we're up. Now it's 28.8, and we do the same thing in 2025. We're now the life expectancy factor is going to be 27.8, and so on. Okay. And we do that continuously. Okay. For years 1 through 9, and then year 10, which is 2032, the entire IRA has to be withdrawn. Whatever's left of the entire IRA balance has to be withdrawn no later than December 31st, 2032. And that's
Sure.
the end of the 10-year period.
So again, what I will caution listeners, because I just did a quick back of the napkin calculation here, Ed. If Daniel inherited a $100,000 IRA, he's going to be pulling in $3,300 out, in that first year, and you had to go up a little bit and a little bit and a little bit. He could have 70,000 sitting there in that last year, depending on what the market's doing and how it's invested, right, and things like that. So, folks, have a plan for this, because as Ed already touched on, yes, they made the penalties easier, and they do give you a way to fix them. But if you miss and miss big, you could be facing a 25% penalty on what you were supposed to take. And right. Ed, could that also include what that giant one-year distribution is? If they missed it, didn't get around to fixing it, that they could be looking at 25% of what should come out in that 10th year?
Yes, they could. They didn't take out a particular what they were supposed to in a given year. Yeah.
Ouch.
But again, Dan, under Secure Act 2.0, if during that 10th year they take out what they were supposed to, and it's not been more than 2 years since it happened, the penalty will be forgiven.
Gotcha. So, okay, Ed, I think that's a good place for us to break, folks. You want to come back for the next webinar, because we're going to continue, and in that we're going to dig into the Roth side. And this is something that more and more people are going to see, because Roths have become more popular over the last 10, 20 years. So more and more people will be inheriting that. You will not want to miss that. Okay. Ed, as always, I can't thank you enough for what you do for us, and especially for the federal community, especially how much you teach everybody, us included. So thank you for that, sir.
My pleasure. Our pleasure.
Well, folks, that's a wrap. We will see you on the next podcast. Don't miss it. Be sure to head over to the Fed Zone to look at Ed's examples. Again, that's fed-zone.com. We are serving those who serve. You should subscribe to this podcast on our YouTube channel and Spotify. And please remember to share it with friends and strangers. Also, check us out. Our live webinars every week. Go to stwserve.com. You will see the blue button up in the corner. Click it. It'll take you to the whole menu. There's a ton there. We're adding new ones this year for special provisions. We're really excited about that. So the guru will come to you, reach you where you are, teach you where you are, serve you where you are. Sign up for one, sign up for all, sign up for two of the same ones, a month apart. We don't restrict you. And we don't restrict by age, okay? We had a 26-year-old on this week, and I was dancing in my chair because that's exactly the person we want to have coming to these as well. If we can get you early, we can help you make this thing sing. So be sure to read Ed every week in the Fed Zone at fed-zone.com. And so for Ed, the crew at Serving to Serve, and me, Dan Sipe, closing as I always do, good luck, Godspeed, and above all, remember, it's your Fed life. Make it a great one because you deserve it. Stay well, everybody. We are out.
Thank you for listening to the FEDLIFE Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Serving Those Who Serve or Raymond James. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Securities offered through Raymond James Financial Services Incorporated, member FINRA SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Serving Those Who Serve is not a registered broker-dealer and is independent of Raymond James Financial Services.
Raymond James is not affiliated and does not endorse the opinions or services of any of the quoted professionals or their respective firms. Any opinions are those of Dan Sipe and not necessarily those of RJFS or Raymond James. This case study is for illustrative purposes only. Individual cases will vary. Raymond James is not affiliated with and does not endorse the opinions or services of the quoted professionals or their respective organizations.
Neither Raymond James Financial Services nor any Raymond James financial advisor renders advice on tax issues. These matters should be discussed with the appropriate professional. Investing involves risk, and you may incur a profit or loss regardless of strategy selected, including diversification and asset allocation.